Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 4th, 2025. I am Luna.
I am JPMorgan. Okay, let's get into those headline numbers then. Pretty impressive stuff. S&P and Nasdaq up, 0.8 to 1%?
That's right. And the Dow Jones gained nearly 350 points, also closing at a record.
And it sounds like tech was really leading the charge. Names like NVIDIA, Microsoft.
Absolutely. NVIDIA, Microsoft, Amazon all climbed over 1%. But it wasn't just those giants.
Oh, really?
No, the report highlighted positive market breadth. About 2/3 of stocks on the NYSE actually advanced.
So wide participation. That signals something broader, right? More than just tech enthusiasm.
Exactly. It points to this underlying optimism, maybe about trade deals, maybe just the general economic backdrop seeming robust, strong corporate earnings expectations. It all feeds in.
Okay, that covers the what. So let's move to the why. What specific data point really moved the needle? Was it that June jobs report?
I think that was definitely a major factor, yes. The non-farm payrolls for June.
It came in hotter than expected, didn't it?
It did. 147,000 jobs added versus maybe 110,000 expected. And unemployment actually ticked down a bit to 4.1%.
Sounds like great news on the surface.
Well, here's where it gets interesting when you dig in. Nearly half of those job gains, government hiring.
Okay.
And private sector job growth actually slowed, hit an 8-month low, in fact.
So a bit of a mixed signal there. Resilient overall, but maybe not as strong underneath.
Precisely. It showed the economy is still holding up, but it definitely dampened hopes for the Fed to cut rates anytime soon.
Right. The higher for longer narrative gets reinforced.
Exactly. That's the takeaway that hit the markets.
And how did we see that play out in, say, the bond market? Or the dollar?
Immediately. You saw 10-year Treasury yields jump up to around 4.35%.
Meaning bond prices fell.
Correct. And the U.S. dollar, well, it climbed to its highest level in months off the back of that.
And was there other data supporting this idea of a maybe cooling but not collapsing economy?
Yeah, the ISM Services PMI for June came in at 50.8.
Above 50, so back into expansion territory for services.
Right. A welcome return, business activity, new orders, they rebounded nicely, although the employment part of that survey did slip a bit.
Okay, so it fits the picture. Gradual cooling, but no panic buttons being pressed yet. Support stocks, at least for now.
That seems to be the read, yeah.
Now, speaking of big economic forces, there was also that huge legislative news out of the House, a $4.5 trillion package.
That's right. A massive tax and spending bill approved. President Trump called it a big, beautiful bill.
So sweeping tax cuts, but also more spending on defense, infrastructure. What are the market implications of something that big?
Well, it creates this real tension, doesn't it? On one side, you've got potentially big tax cuts,
Which could boost corporate profits, maybe spur some growth. Helps explain the stock market optimism, perhaps.
Could definitely contribute, yes. But it's a classic double-edged sword. Because a $4.5 trillion package blows a huge hole in the federal deficit.
Right. That's a lot of borrowing.
A lot of borrowing. It raises serious concerns about, who's going to buy all that new Treasury debt and what does that do to interest rates long term.
Pushes them higher, potentially crowding out other investments.
That's the worry. More Treasury issuance could push rates up across the board, adding another layer to that higher for longer idea, but this time driven by fiscal policy, not just the Fed.
Okay, so putting it all together, what's the outlook for you, the listener? Sources seem to be pointing towards, well, continued optimism, but with some pretty big flashing yellow lights.
I think that's a fair summary. You've got the solid economic data points we discussed. You've got potential fiscal stimulus kicking in. The job market is resilient. Tech and AI are strong.
Lots to like there.
But this very strength is what's making people worry about interest rates staying high for a long time.
Because the Fed sees less reason to cut if the economy is doing okay.
Exactly. And sustained high rates can really put pressure on stock valuations, especially, sectors that rely heavily on borrowing. Think utilities, real estate.
They feel the pinch more.
Definitely. Plus, you've got those other risks simmering. Inflation isn't totally vanquished. There's the debt impact from the new bill. And geopolitical stuff like that upcoming U.S.-China tariff deadline.
So the advice seems to be, stay diversified. Be careful about loading up on those rate-sensitive stocks. That's what the report suggests, yeah. Position for some volatility. Keep watching the economic numbers closely. Don't bet the farm on rates coming down quickly. Right, so the big picture takeaway really is this fascinating balancing act. A surprisingly robust economy, potential stimulus, but facing this headwind from a determined Fed and potentially rising deficits.
It's a complex mix of cross-currents, for sure.
Makes you think, doesn't it?
Yeah.
If we really are in for this higher for longer rate environment, what could the ripple effects be?
Yeah.
Not just for stocks, but for different parts of the economy, for everyday costs, for how businesses plan. How might that change things longer term? Definitely something to chew on.
Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.